So if you look at a business, let's say McDonald's, for example, McDonald's was formed in the, I mean, the business existed, but Ray Kroc took it over in the 1950s. I think they went public in the 1960s. It's been public for maybe almost 60 years since then. It's still growing. The number of restaurants, revenues, profits, etc. I mean, it's gone through some ups and downs over the years, but it's grown, and it's grown spectacularly. And I think from the time it went public till now, it's north of a 10,000 bagger. Every dollar you invested is worth more than $10,000. Not a 10 bagger or 100 bagger, like a 10,000 plus bagger. And why did McDonald's do so well? It did well because in the early days, when it got going, there were a number of initiatives, a number of innovations that McDonald's had come up with. But basically, one of the early innovations McDonald's came up with was that everything they sold could be eaten without a fork or a spoon or a knife. There was no cutlery needed to, French fries, you could just take it from your hand and so on. The other big innovation was that it was served really fast, the production time. And actually, if you really study McDonald's internal processes and how it functions, it's kind of like a light manufacturing type operation. The software and engines they use internally is like what you would use in a light manufacturing operation. And of course, like for example, they were very specific about the way the French fries should be with the Russell potato. So in fact, like for example, when McDonald's enters a new country, like India or Russia, etc., it takes them 2 or 3 years from the time they decide to enter to the time they can open their first restaurant, because it takes a couple of years to train the farmers and generate the supply chain for the right kind of potatoes and such. So it takes them sometimes more than a couple of years just to open the restaurants and such. But the interesting thing about something like McDonald's is that almost all the innovations they came up with, there were a lot of copycats. And there were many businesses that came up that cloned or tried to clone what they were doing. And in general, fast food became a huge industry with many players. It wasn't just burgers. We then got a big kind of growth in pizzas, chicken, KFC. So, a lot of different entrants came in. And also, I think on the consumer side, it also changed in terms of what the frequency people were looking to eat all of this stuff. But anyway, even with all of that competition, McDonald's was able to establish a brand. People knew before they went into a restaurant, any McDonald's, what to expect. The kind of standardization and consistency, the cleanliness, the consistency, and the nature of the service worked. So that particular moat has been going strong for 60 years. There aren't really any signs that say that the moat is eroding and may not do so well in the future. They continue to do well. And it's a very high return on equity business. So basically, if you think about a franchised McDonald's, where an entrepreneur does a contract with the McDonald's Corporation. So in a franchise situation, in the United States at least, a lot of the real estate is owned by the McDonald's Corporation. And the rent that is charged to the franchisee is a percentage of sales, like maybe around 4% of sales is the rent. So if you think about the rent that McDonald's charges its franchisees, it's kind of automatically inflation indexed, just goes up with inflation. They also charge a franchise fee, for the right to use the brand, etc. That might be another 4% or so. And then the franchisees also buy a lot of the products they need from McDonald's. And usually what McDonald's and a lot of the other franchise type operations will do is they tend not to focus on making money on the products. They tend to focus on passing that through. But you have the two main engines of the franchise fees and the rent, which might be something like 7-8% of the top line. So if you look at it from the McDonald's Corporation's point of view, a typical McDonald's in the US might have something like 2 or 3 million in annual sales. And the McDonald's Corporation might get something like 150, 200,000 a year from that location. The capital they have to put up against that is almost non-existent, because it's the entrepreneur who's paying for all the capex, and the maintenance capex and all of that. So it's a very capital light business. So the three legs that we need, I think Chuck Akery called it the three-legged stool. The three legs that we need for these long multi-baggers is, first of all, the core economics of the business should have very high returns on invested capital, ideally without the use of debt, right? So you basically, like McDonald's doesn't need to borrow money to make a lot of money. The second is that we want very high integrity management, and we want insider ownership, kind of alignment of interest, where there's a smart entrepreneur or someone or insiders who own it, so they've got incentives. And the third is that we want a very long runway, so where we can see that this thing can go on for a very long time.